Yes, thank you very much. And I think this part of the panel, together with Fabio Panetta from the ECB, is also about Europe. So the focus, we were told, is not only Greece. But I'm happy to be back, to say that in the beginning, even under these very unusual circumstances. Undoubtedly, we are experiencing the worst economic crisis in 100 years. And I do not expect economic performance in the euro area to return to pre-crisis levels before 2022. Of course, we also face all the other challenges that President Hollande and Sigmar Gabriel talked about earlier, but I think it's my role here to focus on economics. Between March and May this year, the European economy suffered a brutal collapse, and after the economy reached its lowest point in April, we saw clear signs of a recovery, so we are in a recovery, from May onwards. Many indicators improved significantly the following 3 months. But the recovery lost momentum again in August as uncertainty about a second wave of infections remains high in some euro area countries. But overall, I think the outlook is a bit better than what you, Joan, said in the beginning, also based on the latest ECB projections. And I don't agree with you when you said that Europe is more affected than the rest of the world by the pandemic. And just to give one number, to go look outside Europe, ILO, the International Labour Organization, said last week that because of this pandemic, 400 million people will lose their job around the world. So I think we should be careful not to think that Europe is worse off. But there are big challenges, and the pandemic, although it was a symmetric shock, has had different economic impacts in different member states, so asymmetric effects. This increases the risk of economic fragmentation between countries, and that's why it is important that measures were taken at the European level to prevent distortions in the EU's single market and to prevent divergences in the monetary union. And therefore, I think the title of the conference, Reinforcing Cohesion in Turbulent Times, this is exactly what Europe is trying to do. And Europe responded quickly to the pandemic with policy measures designed to help particularly the most affected countries. At the beginning of April, euro area finance ministers agreed on 3 safety nets worth a total of 540 billion euro. Each of these safety nets has a different purpose. The ESM's pandemic crisis support helps countries to cover the direct and indirect healthcare costs. The Commission's SURE program is a safety net for workers. The new guarantee fund of the European Investment Bank can be used to finance corporate investment. At the same time, monetary policy measures by the European Central Bank have stabilized financial markets, and I'm sure Fabio Panetta will explain that in a moment. And in July, the 750 billion Next Generation EU recovery plan of the European Commission was adopted. This is a lot of money. And as the President of the European Council, Charles Michel, said last week, it is not a 3 or 7 year strategy, it's a 30-year strategy. Complementary to the work at the European level, euro area countries responded with very extensive national fiscal policy measures. All euro area countries support their economies through discretionary fiscal policy measures, guarantees and liquidity support, and deferrals for taxes and social security contributions. In total, these measures amount to more than 1/3 of euro area GDP. Automatic stabilizers amount to around 5% of GDP, and consequently, The budget deficit for the euro area as a whole is estimated to reach around 10% of GDP this year and 5% next year. But next year, of course, will depend on the progress of the pandemic, the strength of the economic upswing next year, and the extent to which state guarantees will be called upon. Obviously, the Greek economy had to cope with the pandemic too. Minister Staikouras talked about that. The pandemic has put an additional and unexpected strain on the Greek people, the Greek economy, and its public finances. The Greek economy is particularly affected by the pandemic due to its large service sector, especially tourism, and its large share of small and medium-sized enterprises. The Greek government has managed to contain the spread of the virus and mobilized a large set of support measures to mitigate the burden on its population and firms. The flexibility of EU fiscal rules has also helped, although we will see large budget deficits in all European countries this year due to the economic downturn and the very necessary fiscal measures to deal with the pandemic. To ensure the sustainability of public finances and to increase the economic welfare of Greek citizens, it is crucial to place the economy on a higher long-term growth path while maintaining a prudent fiscal stance. Over the past years, Greece's economy experienced a large capital depletion, and it very much needs investment to rebuild its capital stock. So far, the investment rate remains well below the euro area average, and this is holding back potential growth. That is why policy reforms need to focus on structural, growth-friendly initiatives with special focus on improving the quality of institutions and the business environment in Greece. These reforms should mainly aim at boosting the country's long-term potential and not on short-term gains. Domestic and foreign investment need to be incentivized, also through more public investment. In this regard, we acknowledge the government's steps to further improve the business environment and to remove structural obstacles for implementing the public investment budget. We also welcome the growth strategy presented in the Pisaridis report. It proposes to increase the openness of the Greek economy, which would help attract foreign investment to Greece. Looking ahead, working on a credible reform agenda and remaining on a prudent fiscal path is important for supporting the country's exit from the recession and for helping the country sustain growth in the medium and long term. The current crisis is very painful for all European countries, and actually for almost all countries around the world. At the same time, it has the potential to accelerate structural changes in our economies and to make progress in European integration. This is crucial because I see 4 problem areas that could negatively affect future growth, and I'm now talking about all European economies. First, looking at potential growth. Potential growth rate is very likely to be lower after the crisis than before the crisis. The pandemic is destroying capital, physical capital, and human capital. It is causing businesses to invest less, given the high degree of uncertainty, and it has led to much higher private savings, which is reducing overall economic demand. Second, the collapse of world trade means less competition and thus lower productivity gains. And this collapse of world trade comes on top of deglobalization, already visible before the pandemic, and this also dampens potential growth. Third, I'm concerned about the banking system, and again, I'm not talking about Greece, I'm talking about Europe. Banks continue to make too little profit in Europe. There's overbanking in some countries, and there will be an increase in non-performing loans due to the economic downturn. All this can affect the credit supply to the economy, and this would also reduce growth. Fourth, higher public debt, which is of course now indispensable, but it can have a negative impact on growth in the long term. The return to sustainable fiscal situation will not be easy. Given all these challenges, all European countries should prioritize strengthening productivity and competitiveness in the future while promoting a green and digital economy. This must happen as countries use the money that will be made available by European institutions the next 3 years. And this amounts, when you add it all up together from European institutions, to more than 1 trillion euro, an unprecedented amount. This should be used well, and the minister talked about that, and it's true for all European countries, in order to reach a more resilient, more innovative, and more sustainable Europe. To get there, this also implies further deepening of monetary union. This will help us face future crises with greater strength. The agenda for deepening EMU is well known and contains the following points. First, completion of ESM reform to ensure financial stability in the euro area. Second, completion of banking union with a backstop and a common European deposit insurance scheme. Third, the creation of capital markets union to harmonize all 27 financial markets. Fourth, the creation of a fiscal capacity for macroeconomic stabilization to cushion economic downturns. And fifth, the increasing the volume of safe euro assets further to strengthen the international role of the euro. I agree with what Sigmar Gabriel said earlier, that a stronger euro that should play a key role in the international monetary system is essential to maintain and improve European sovereignty. And I think there's a good chance that we can move to a multipolar international monetary system if we continue with our agenda of deepening EMU. Thank you very much. I think Fabio Panetta is waiting.